Hi, this is Vijay Bambani and I'm back again, this time extremely happy because of all the feedback that I've got from you about my video on Fibonacci analysis while trading. Keep your feedback coming in, guys. When you don't talk back to me, I feel like I'm talking to a brick wall. So I'm going to take up where I left from in my previous video on Fibonacci trading. In the last video, we talked about extremely basic entry-level stuff about how you have to take 38.2, 23.7, 50%, 61.8% Fibonacci retracements. And how, since the markets had become faster, waiting only for the golden mean did not make sense. There are, however, other aspects to Fibonacci trading. Rank and file traders think that the Fibonacci ruler must begin at the extreme low point of the swing low, span the ruler all the way up to the highest point of the swing high, and then measure the retracement level. Is that really right? The answer is yes and no. Depending on how a majority of the people are placing the ruler and placing their bets accordingly, the prices might react so. But there are many a times the market does not really bottom out or top out in one clean V or an inverted V fashion. If this is a bottom, the market might just come multiple times at this support and then finally take off. There are times when the bottom could be slightly lower, a successive bottom could be slightly lower. There are times when the final bottom before the rally takes off could be slightly higher. What is the most precise point to start your Fibonacci ruler from point 0 going all the way up to point 100? Logic tells you, and here behavioral science comes into the picture. Behavioral science tells you that traders are most interested and are likely to remain their most recent trade as an anchor point. This is in behavioral analysis called the recency bias. The entry level which you took at the most recent point, and especially from where your trade is still alive, will be what you are concerned with. So I would suggest you first take a Fibonacci ruler starting from the most recent low rather than the absolute low, and then plot it all the way to the top. See if this Fibonacci ruler of 23.7, 38.2, 50% and 61.8% has been respected by the markets as a support and resistance multiple times. This is something we traders call eyeball testing. By seeing at a chart, you will see how many times the market has respected or violated those particular levels. And then plot another Fibonacci ruler from the extreme low to the extreme high and see which one of these two rulers is the market actually acting as a better or a more robust support and resistance. More often than not, in a rational market, and especially on extremely short-term charts of 1 minute or lower, I have found that the Fibonacci ruler works better when you take the most recent low rather than the absolute deep low. The other aspect that needs to be taken into account before placing your trades on Fibonacci style analysis is how do you account for the gaps in the prices. More often than not, many a times the price opens with a gap up or a gap down. Now, how do you account for this window or a vacuum in the price? Here again, it depends on what a majority of people are doing and therefore acting accordingly. Technically speaking, if at all there is a 10 rupee gap in the price, you should not take the Fibonacci ruler from the absolute bottom to the absolute top, but 10 rupees below the top so as to adjust for that 10 rupee gap where no trade has taken place, but it was sentiment that resulted in this open window. Here again, you might want to resort to eyeball testing, because just because you know this little secret that I'm sharing with you now does not mean that everybody knows this secret, all right? So maybe the others are going with the same old plain vanilla Fibonacci analysis, and let's not forget what we discussed in the last video on Fibonacci. It can be, to a certain degree, sometimes a self-fulfilling prophecy. Fibonacci works because a lot of people are depending on it and placing their bets accordingly, and therefore their trades are impacting the price. So is Fibonacci working because traders are placing their bets according to Fibonacci levels and impacting the price, or is the price getting impacted because Fibonacci works? It's like what came first, the chicken and egg theory, right? Let's not even get into it. What we need is the kind of study either from the absolute bottom or to the recent bottom all the way up to the top, and then account for that 10 rupee gap in the price by placing the ruler 10 rupees below the absolute top, or placing it all the way to the top and seeing which level is the market and the price respecting more. You go with the flow and don't fight the flow. That's the way a smart trader makes money. I'm going to share with you some more cutting edge secrets on Fibonacci trading. Do bear with me, and do not forget to click like on this video. Don't forget to share this video with family and friends, and in the comment section, do let me know how you like this video. Of course, I'm coming with more Fibonacci stuff, a little more advanced than this one and the previous one. Also, do not forget to subscribe to my YouTube channel. And guys, I'm also looking forward to seeing you on my Instant Income Summit on 21st of Jan, Tuesday at 5 p.m., which is absolutely free, where I'm going to share with you my new product, something that's revolutionary and exciting. I'm very excited about seeing you, so do join me there. This is Vijay Bambwani signing off for now. Do take very good care of your trades and investments. Thank you. Also, do not forget to subscribe to my free email newsletter, Fast Profits Daily, and get my free guide, How to Trade Markets Like a Pro.